If you're a doctor, you're probably losing hundreds of thousands of dollars a year to taxes. That's why I want to share a little known tax strategy that can make a big difference. Did you know that you can use your medical office to legally shelter a big chunk of your medical practice income? And did you know that you can do this without qualifying for any special tax strategy like real estate professional status? You don't need to deal with tenants, you don't have to deal with guests staying at your Airbnb, and you don't need to change anything you're doing. This isn't some sort of gimmick or trick. It's called the medical office tax loophole. It's one of the most underutilized strategies out there. Most CPAs don't know about it, which is probably the reason why they've never brought it up. In this video, I'll walk you through exactly how it works, share a real life example from one of our students, and show you how easy it is to qualify for this tax strategy. And if you're already familiar with REPS or the short-term rental tax strategy, we'll show you how this fits in with those two. But first, let's break down what makes this strategy so powerful and why your CPA doesn't even know it exists. Hi, I'm Dr. Kenji Asakura. I'm a physician, real estate investor, and co-founder of Semi-Retired MD. Over the years, my wife and I have used multiple real estate strategies to shelter income, build long-term wealth, and dramatically lower our tax bill. In fact, we didn't pay any federal income taxes for 7 years in a row. But today, I want to walk you through a strategy that almost nobody talks about, even though it's perfectly legal and it's written into the tax code. Now, quick disclaimer. I am not a CPA, so everything I'm sharing is for educational and informational purposes only. If you want to implement this or any of these strategies, be sure to consult with a CPA who specializes in real estate. So how does this strategy actually work? By taking advantage of an IRS rule called a grouping election, which you can find in Section 469 of the Internal Revenue Code. This lets you treat your medical practice and the medical office building you own as a single activity for tax purposes. And here's why this matters. Because this allows you to take any losses from your office building, mostly due to depreciation, and directly offset the income from your medical practice. Most doctors create two separate entities, usually LLCs. The first LLC owns the medical office building, and the other LLC owns the medical practice. Your medical practice pays rent to the LLC that owns your office building. The office building then pays expenses like mortgage, property taxes, utilities, and insurance. And the other really big expense is called depreciation. This is where the IRS lets you deduct the wear and tear of the building, even though the real estate usually appreciates in value. If those expenses, including depreciation, are more than the rent collected, the LLC shows a paper loss. Because of the grouping election, this loss offsets your medical practice income, lowering your taxable income. That means less income on paper and less tax owed in real life. It's one of those strategies that feels like, wait, how is this even allowed? But it's not a loophole in the sketchy sense. It's written right there in the tax code. And what I like the most is that it doesn't require real estate professional status or the short-term rental tax strategy to pull it off. Let me show you how impactful this can be in real life. One of our students, a practicing OBGYN, was going through a real estate course when she decided to purchase her own medical office building. When we found out, we told her about the strategy and then connected her with a real estate savvy CPA. She set up her LLCs and the grouping election properly from the start. The result? In her very first year, she was able to shelter all of her medical practice income using losses from the building. And here's what's really cool about the strategy. She didn't need to qualify for REPS. She didn't need to do the 750 hours. She didn't need to buy a short-term rental and manage guest stays. She just bought an office for her practice like she normally would have done, and then implemented the tax strategy with the help of her real estate CPA. That's the beauty of this loophole. This is the kind of result that makes you wonder, why isn't every high-earning doctor doing this? And unfortunately, the big reason is because most CPAs just don't know about real estate tax strategies. And it's not their fault. They just don't specialize in this space. It's like a family practice doc trying to practice neurosurgery. A family doc just isn't trained to operate on the brain. And a regular CPA isn't trained to help their clients with tax strategies involving real estate. So if this is completely new to you, you're not alone. But the opportunity is real and the tax savings can be huge. Now let's take it one step further. If you want to turbocharge those paper losses and tax savings in the early years, then you'll want to use bonus depreciation. You might be asking, what is bonus depreciation? Well, normally the IRS spreads out depreciation over decades. For an office, it's spread out over 39 years. But with bonus depreciation, you can front load the depreciation and shelter a big chunk of your medical practice income in the early years of ownership. Here's how it works. Let's say you buy a $1.2 million medical office building. With bonus depreciation, you can deduct hundreds of thousands of dollars a year in the first year alone. You then use the losses created by bonus depreciation plus other expenses to directly offset your medical practice income, thanks to the grouping election. Remember, the losses created by bonus depreciation are paper losses. You're not actually losing money. Your building could be going up in value while the IRS lets you deduct like it's losing value. If you want the full breakdown of how bonus depreciation and cost segregation works, check out the video linked below. I'll walk you through it step by step. But here's the big takeaway. This is a great way for a busy doc to reduce their taxes without changing their job, their schedule, or their lifestyle. And it's built right into the tax code. Now, before you go out and buy an office building just for write-offs, let me give you a quick reality check. Tax benefits don't turn a bad deal into a great one. You still need to buy a solid asset that makes sense financially, even if you plan to occupy it. The doctors in our community who've done this well follow the same investing fundamentals we teach in our Zero to Freedom course. They run the numbers, force appreciation through smart upgrades, and think long-term beyond just the taxes. Before you try to set this up, be sure to work with a CPA who specializes in real estate. Most general accountants will either miss this completely or be too cautious to implement it. If you want to save time, we've linked our trusted CPA partners below who are experts in real estate tax strategy. Now let's zoom out for a second. This strategy works beautifully on its own, but if you do qualify for reps or are already using the short-term rental tax strategy, you can combine that. We've personally done this, stacking strategies to maximize the tax savings. The key is learning the rules, playing the game strategically, and working with people who know how to win it. So there you have it, how the medical office tax loophole works, who it's for, and how to make it work for you. If you're a doctor who wants to build long-term wealth and legally lower your tax bill, this strategy might be the missing piece. Now, if you want to learn how to buy and use real estate the right way, check out our Zero to Freedom course designed specifically for doctors and high-income earners. You can enroll anytime using the link below. Thanks for watching. If this helped, hit that like button, subscribe for more, and share it with a colleague who's tired of paying too much in taxes.